Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Energy Transfer LP, ticker symbol ET. So we're looking at Energy Transfer as a continuation of looking at oil and natural gas businesses. Energy Transfer is one of the top performing businesses over the past year. And so what are we missing? What could the market possibly have discovered about this business this year that led to this kind of performance? So right now, Energy Transfer is trading for $11.60 per share. Over the last year, their stock price is up 43%. And in addition to this, they're currently paying out a 7.3% yield. So Energy Transfer has returned over 50% to shareholders during this time. Also to note is that we're recording this video while the market is open, so their stock price is going to be changing around just a little bit during our analysis here. Over 5 years, however, it's a different story for the business. Their stock price is down 30% overall. Over 10 years, their stock price is basically flat. They're only up a little under 4%. And going back nearly 17 years prior to the global financial crisis, Energy Transfer is compounding at a rate of just under 5% annually. Again, keep in mind that their average dividend yield over this time would be in addition to this compound annual return. Even though they're up by nearly 50% so far this year, they have not had a ton of volatility in their stock price. They're about $1 below their 52-week high, and they're about $3 above their 52-week low. About 2.5% of their shares outstanding are currently sold short, and they're a large business. They have a $37.5 billion market cap, but they have a ton of debt, and so the business has nearly a $99 billion total enterprise value. For more background about the company, Energy Transfer owns a large platform of crude oil, natural gas, and natural gas liquids assets primarily in Texas and the U.S. mid-continent region. It also has gathering and processing facilities, one of the largest fractionation facilities in the United States, and fuel distribution. Energy Transfer also owns the Lake Charles gas liquefaction facility. It combined its publicly traded limited and general partnerships in October of 2018. Energy Transfer was founded in 1996 and is headquartered in Dallas, Texas. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Energy Transfer based off of their business fundamentals. So this analysis is still an evolving process. It will continue to improve and get better over time, and it's an opportunity to learn in public. So with that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 major reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second is that the average publicly listed business earns about a 7% return on capital. So by looking for a benchmark of 14% or higher here, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. So over the last 5 years, Energy Transfer has increased their returns on capital. They dipped slightly in 2020, but since then they've been rebounding. Over their last 12 months, they're earning about an 8.5% return on capital, which is down a little bit from their fiscal 2021. Averaged out over this time, however, over these last 5 fiscal years, Energy Transfer is only earning about a 7% return on capital. So that's right in line with an average public business. But that's only half of that 14% benchmark we're looking for, so this is an X to start things off on metric number 1. Next up, for metric number 2, here we're taking a high-level overview of the growth of the business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. And this metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of them is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in our calculations here. Over this time, Energy Transfer's revenues have actually more than doubled, including to the present day. Their earnings are up quite dramatically as well. They had a couple of impairment of goodwill charges in both 2017 and 2019. And their free cash flow has gone from negative to positive over this time, due in large part to a huge amount of capex that they spent in 2017. So all 3 of these are up by a strong amount here. It's especially good to see that they've increased their cash flows so dramatically, because free cash flow is really the lifeblood of any business. And a business can use its free cash flows to buy back shares, pay down debt, make acquisitions, pay dividends, or reinvest back into the business. Ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be worth. So great to see such strong free cash flow growth, and great to see growth across the board here for Energy Transfer. This is our first check of the day coming in on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Energy Transfer on a per share basis. So we're looking for earnings per share growth over the last 5 years. So we learned that their earnings are up quite dramatically over this period. However, earnings are just the numerator in this earnings per share equation. We still want to look at what they've done in terms of their shares outstanding. And this is where some of the history of the business can get complicated because in part they merged their general and limited partnerships in 2018. The company has issued about 2.6 times the number of shares outstanding that they've had to start this period. So at face value, this is massive shareholder dilution with just an incredible jump from 2018 to 2019. However, it's because they merged those two partnerships that this is the case. So even with that huge amount of dilution, their earnings are actually still up at a rate that's faster than this. So their earnings per share have grown over this period. And this is our second check in a row here on metric number 3. Next up, metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. Their free cash flows were negative in 2017 and 2018, and they've been quite positive since 2019. They're especially quite positive over fiscal 2021 and over their last 12 months as well. This is another check here on metric number 4, and so far through our first 4 metrics, we have 3 checks and 1 X for Energy Transfer. Then next up for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. We want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that they produced over the last 5 years. Energy Transfer, by the nature of their business as a pipeline company, is going to tend to have a lot of debt because they tend to be relatively stable businesses that often have contractual agreements, which makes their free cash flow somewhat more predictable to project into the future. Energy Transfer ended 2021 with $50 billion worth of net debt. Currently, they've brought this down some. Right now, they have $48 billion worth of net debt. Over this time, however, Energy Transfer has only produced about $8.3 billion worth of free cash flow. When we sum up all of these previous fiscal years, that's just about a sixth of what their net debt position is right now. So this is an X here on metric number 5. It's worth noting, however, that they produced over $8.3 billion worth of free cash flow alone in 2021. And over their last 12 months, they produced $6.2 billion worth of free cash flow. So while the business does use a large amount of debt in an absolute sense, if their current free cash flows are going to be more typical for the business going forward, then it looks like this debt position is maybe not as much of a concern as it would be when we're just looking at their historical free cash flows, especially looking at their free cash flows before they merged their general and limited partnerships. With such high debt loads on the business, this is something that you'll likely want to dig into and learn more about, and you can read through the company's filings to get a deeper perspective around the company's debt profile. Either way though, again, this is an X, and so far through our first 5 metrics, we have 3 checks and 2 X's for Energy Transfer. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a slight risk premium to the yield of the 10-year treasury and potentially give us another reason to be interested in the business. So we're using their total enterprise value here because it takes into account both their market cap and their net debt position, and it's going to give us a more accurate perspective of the underlying economic reality of the company that's more similar to as if Energy Transfer were a private business. So right now, Energy Transfer has about a $99 billion total enterprise value, and we learned that over the last 5 years, they produced about $8.3 billion worth of free cash flow cumulatively. So that means that in an average year, they're only producing $1.7 billion worth of free cash flow. So when we take their $1.7 billion of their average free cash flow and divide that by their $99 billion total enterprise value, that only gives us a 1.7% average free cash flow to enterprise value yield. So on an average basis here, this is an X on metric number 6. However, as we pointed out in our previous metric, over the last 12 months, they've produced $6.2 billion worth of free cash flow. So to get a current free cash flow to enterprise value yield for the business, when we divide their $6.2 billion of their last 12 months worth of free cash flow by their $99 billion total enterprise value, that gives us about a 6.3% current free cash flow to enterprise value yield there. So that would be above both the yield of the 10-year treasury and above that 5% benchmark we're ideally looking for a slight risk premium. So again, in large part, any sort of thesis around Energy Transfer is going to depend on whether or not they're able to maintain their current levels of free cash flow going forward as a new normal for the business. This is something that you're ultimately just going to have to dive in deeper and learn about the business in more depth to fully understand. Then here we're looking at Energy Transfer's dividend profile. So again, Energy Transfer is currently paying out a 7.3% dividend yield, which is well above that of the yield of an S&P 500 ETF right now, more than 5 times better than that yield. However, people make mistakes all the time by blindly chasing dividends, so it's important to stop and look at the underlying fundamentals of a business and to determine whether or not that company is able to comfortably support their dividend payouts with either their earnings or their free cash flows. For Energy Transfer, we want their dividends to be supported by their free cash flows, and that was only the case in one of these previous 5 years. Energy Transfer only supported their dividend payouts in 2021, and in these other years, they were not bringing in enough free cash flow to comfortably pay out this dividend. As a result of that, they have decreased their dividends per share over this time frame. But both in 2021 and over their last 12 months, they were able to very comfortably support this dividend yield, again on the back of higher free cash flows recently. Research into this business is really going to depend on if their cash flows more recently are more normative for the business going forward or not. If that is the case, it looks like the company would be potentially very easily able to support their dividends into the future. If their free cash flows regress to where they have been historically, then it looks like the company would be able to support their current dividend yields, but might potentially have trouble growing those again into the future. Then everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Energy Transfer, which takes us on to using a discounted cash flow model to come to a potential fair value for the business. A discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So starting with an average of their free cash flows over the last 5 years, including their last 12 months worth of free cash flow in this average, then assuming a growth stage for the business based off how they've been able to grow their free cash flows over the last 10 years. These are historical growth assumptions that you need to do your own homework on to determine whether or not these are going to be potentially accurate and applicable going forward to give us a baseline projected estimate for Energy Transfer. So assuming a growth stage over the next 10 years where they grow their average free cash flows at a rate of just under 2% annually, then assuming a terminal stage for the 10 years out after that, where these free cash flows stay about flat. If we were seeking a potential 10% rate of return from the business, then it looks like a fair value for Energy Transfer is right around $15.70 per share. Please be mindful of a couple of caveats. One is that this discount rate would be including their dividend payouts. So right now they have a 7.2% dividend yield, so that would be included in this 10% discount rate, and their actual stock price would only be increasing by about 3% annually. So we would not be doubly counting dividends. 2, is there a variety of reasons why this might not be potentially accurate, which is really why it's up to you to dive deeper into the business and learn more about it. And then 3, this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. From today's valuations, using these same historical growth assumptions with these same caveats, it looks like you could reasonably expect about a 14.5% rate of return from Energy Transfer, which would again be including their dividends. So in just a minute, we'll talk about a recap for Energy Transfer, but we have to address something first. What are some of the qualitative aspects of this business, especially those around a potential long and a potential short thesis for the company? So starting with some of the key points around a potential long thesis for Energy Transfer. Number 1, Energy Transfer is well positioned to benefit from the outlook for growing natural gas liquid exports. Number 2, Energy Transfer is diversified across markets, commodities, and geographies, giving the company access to many large customers. And number 3, Energy Transfer's consolidation in October of 2018 reduced the company's cost of capital and helped fund its growth projects over the last few years. Then for some of the key points around a potential short thesis of the company. Number 1 is rising interest rates could make Energy Transfer's distribution less attractive as a fixed income alternative and raise the company's cost of capital. Number 2, Energy Transfer has historically been active in the mergers and acquisition market, exposing the firm to the risk of overpaying for growth as the Enable transaction has demonstrated. And number 3, a long-running legal battle threatens to halt operations on the Dakota Access Pipeline, demonstrating the substantial legal and regulatory risk Energy Transfer faces. So hopefully that offers a balanced perspective around some of the key aspects around a potential long and a potential short thesis for the company. Now let's get into our recap. So in summary, Energy Transfer checks the box on 3 out of 6 of our metrics. They're earning just about average returns on capital. Since consolidating their general and limited partnerships in 2018, their revenues, earnings, and free cash flows are up quite strongly. And even with the number of shares that they had to issue to make this consolidation happen, they've still grown on a per share basis. who transfer and store hydrocarbons. The company is using quite a large amount of debt in their business. That's the case especially compared to their historical free cash flows. However, looking at their free cash flow over the past couple of years and currently, it does look like their debt loads are potentially more reasonable now. If their current free cash flows are more of the normal going forward for the business, that's also the case when looking at both a free cash flow to enterprise value yield and comparing that to the yield of the 10-year treasury, and when looking at how the company is paying out dividends. Again, further research into this business is really going to be needed in order to determine what their free cash flows are going to look like over the next 5, 10, and 15 years. Are they going to continue at the increased rate that we've seen recently, or are they going to fall back to where they have been at historically? Then finally, performing a discounted cash flow analysis of Energy Transfer based off historical growth assumptions for how they've grown their free cash flow since becoming a publicly listed business. So if you've done the work and you believe these historical growth assumptions, then it looks like from today's valuations, you could reasonably expect about a 14.5% rate of return going forward for Energy Transfer. That would be outpacing their performance so far as a public business, and half of that would be returned to shareholders through their dividend yield. Again, there are a number of reasons why that might not be potentially accurate or applicable, so again, it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Energy Transfer. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct your research as if you're going to own 100% of a business, and you can truly understand its ins and outs and understand the essence of the company and what's going to matter and what doesn't matter for the business going forward. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Energy Transfer, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Energy Transfer LP, ticker symbol ET. Again, we looked at the business as a continuation of looking at energy companies. It doesn't hurt that right now the company is paying out a 7.2% dividend yield, which again is well above that of the yield of an S&P 500 ETF by nearly 5 times that amount right now. If you learned something and or you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Energy Transfer with me, and have a great day.